Hello, this is Jeff from E-mini Edges, and in this video I'm going to take a look at an indicator that can be used on a weekly chart to help identify the major bull and bear cycles of a market. What we have here before us is an ES chart. That's the S&P E-mini futures contract on a weekly basis. So we're going all the way back here to 1997 and 1998 and looking at the weekly price. This indicator that I'm going to show you was inspired by an article called Combining RSI with RSI by a gentleman named Peter Connor. You can find this article in the January 2011 edition of Technical Analysis of Stocks and Commodities. I encourage you to go look at that if you find this interesting. The premise here is, how can we identify the major bull and bear market cycles? Bull, bear, bull. Of course, this is obvious in retrospect, but how can we identify this in real time? He comes up with a novel way of using the RSI indicator. One indicator, the RSI indicator, to identify major bull and bear markets. Let me show you what this looks like in the form of a strategy. And there we go. We can see this identified quite successfully. Major bull and bear, bull, bear, and of course now currently in 2010 and 2011, the current bull market that we're in right now. This is what the strategy report looks like. $61,000 trading one contract, and it's of course only made 4 trades, and we have a current trade on right now with an open position profit of $18,000. The performance graph, let me shrink this up here, looks like this. But of course, this isn't a system. What we're interested in is an indicator to help us position ourselves. Are we in a bull or bear market? So how does he do this? Let me bring up an RSI indicator. Okay, this one's modified slightly just to match the tweaks that I did. I took his premise and actually used an exponential moving average to help smooth it out just a little bit. But essentially, he breaks up the RSI indicator into 2 zones, which we're relatively familiar with, a 40 down here and a 60 line here. And what he noticed is, during bull markets, rarely does the RSI go below that 40 level. And during a bear market, such as in here, rarely does it go above 60. So he uses those transitions as a trigger. So for example, let's just say we're in this bear market here in 2001, 2002. Well, the RSI stays down here in this lower zone until here, where for the first time in many months, years in fact, it climbs above 60. Likewise, until the financial crisis, here we're exiting in January of 2008, because the RSI falls below that 40 level for the first time in several years, nearly 5 years. So it's that simple. I'm going to shrink that down to show you that after the dot-com bubble, we got our signal to sell right there. So that was October of 2000. We got back in the market in June of 2003. The financial crisis of January 2008, we got out. And of course, we got back in, let's see here, August of 2009. And of course, we're holding on to that right now. I turned this into a paint bar indicator, so let me load that now. And there we go. Basically, I'm taking the 3-period exponential moving average of the RSI just to smooth it out a little bit, but you probably really didn't even need to do that a whole lot. But I thought it smoothed out the gyrations a little bit better. So the indicator in the form of this paint bar is available at the bottom of this post, and likewise the strategy too is available. I wouldn't say it's a strategy you can trade. It's simply an indicator. I hope you find this useful. I thought this was a very novel way of using RSI. So until next time, thanks.